Hi, everybody, and welcome back to Chapter 7, video number 3. When we left off, we were looking at the guard company, and they had some inventoriable costs here. So, what are we going to do for number alpha here? What amount should they report as its basketball inventory? So, we'll take a look at that. Here's that 200,000 here. That they have on hand, but they didn't include 25,000 of basketballs purchased from Ryan at FOB shipping point. Should have done that. So we should add that, and 22,000 of basketballs sold to Moore FOB destination. That in transit inventory still belongs to us, guard. So as I look here, I'm going to add these three pieces together, and I get $247,000 of basketball inventory balance. Now, the inventoriable costs, we'll take a look at that. We had 507,500 purchased for retail. We have to add our freight in on top of that. That gives us 526,720. But then we have to back out our purchase returns and purchase discounts here and here. And that gives us an inventoriable cost of 512,530. Marketing expense and freight out are recorded as selling expenses. Freight out is not included in inventory. Okay. Let's describe and compare the cost flow assumptions used to account for inventory. Here, companies with large amounts of inventory of similar items do not use the specific identification method. I have never used the specific identification method except when I used to sell diamonds to my friends. And then those were specifically identified. But as a result, the companies use one of several systematic inventory cost flow assumptions. The accounting standards allow us to make a cost flow assumption, and we're going to assume that the goods are sold in a certain pattern. They don't necessarily need to be sold in that pattern to be compliant. So a company's major objective in selecting a method should choose one that under the circumstances most clearly reflects periodic income. So here is the ZenLife transactions in the cost of goods sold formula. And here we start out with beginning inventory, which is 0. We've added some purchases here. Then that gives us the cost of goods sold available for sale. These are purchased in a period of rising costs for a total of 43,900. Our ending inventory is 6,000, and our cost of goods sold units were 4,000. And that is, we're going to calculate ending inventory cost and cost of goods sold associated with that. As you can see, these two question marked items will need to add to 43,900. So let's take a look. We are going to look at the cost flow FIFO, LIFO, average cost. The cost flow assumption adopted does not need to be consistent with how we really physically move the goods. That's sometimes surprising to students. The method adopted should be the one that most clearly reflects periodic income. So here we'll look at specific identification, and we know exactly which units came from which purchase here. So that makes that really easy. We know which is in our inventory here and what we sold here. So We know 43,900, and as I mentioned, that's our cost of goods available for sale here. And we know the ending inventory because it's given to us in the problem. So we can back into cost of goods sold. So that specific identification method, as I say, I've never used that in the real world for big league business. For my little diamond business, yes. Okay. Which cost flow assumption to adopt? Specific identification, it includes in cost of goods sold the cost of those specific items that we sold. In my case, the exact diamonds that I sold. And I keep the ones I didn't sell. That's used when we're handling a relatively small number of costly, easily distinguishable items, such as diamonds. It matches the actual cost against the actual revenue. And the cost flow matches the physical flow of the goods. And it could allow a company to manipulate net income. If it wanted to minimize net income, it would pretend, in my case, that I sold a more expensive diamond than I really did. Okay. So, average cost. Here, the prices in inventory are based on the average cost of all similar goods available during the period. It's not subject to income manipulation, and it measures the specific physical flow of inventory. Measuring that is often impossible. Okay, so periodic method, they're going to use periodic method here and has 6,000 units of ending inventory. How would you compute its ending inventory and cost of goods sold using the weighted average method? Well, pretty easy, actually. We're going to take all these 10,000 units that we purchased here. We didn't have any beginning inventory, or we would have included that. We'll divide that by 10,000 units, and that means that our weighted average cost is $4.39. So when we sell them, our cost is going to be $4.39. When we keep them in inventory, in this case 6,000 units, we're going to value the inventory at $4.39 per unit. Okay, and we can back into cost of goods sold that way. Now that was the periodic method. Now perpetual method, a little bit different. We're going to do this row by row. So here we have 2,000 units at $4, that's 8,000. So at that point, we have our average price would be $4. We added another $26,000 worth of merchandise on March 15th here. Now on March 19th, we're going to sell 4,000 of the little beauties. So we go back and we add these two together, 34,000 plus 8,000, that'll be 42,400, and divide that through by the number of units that we're going to sell, or that we purchased here. So in this case, it would be 10,000. So in that case, we have an average cost of $4.30 here. Okay. And then I guess you can see that Callmart is going to compute a new average unit price each time it makes a purchase. Okay. So I think it's a little bit different. Periodic, we do it all at once at the end of the period. Here we do it only when we actually sell something. So we're keeping track along the way. So here was our 8,000 units. 2 of them was at $4, 6 of them were $4.40. Our average price at that point was $4.30. Okay. FIFO. FIFO assumes the goods are sold in the order in which they're purchased. It approximates the physical flow of goods. Its ending inventory is close to the current cost because those are the last units that we purchased. We're selling from the top down. But it doesn't match the current costs against current revenues. That's FIFO's shortcomings. Not. So here, we're going to do this under a periodic system. We're going to do it somewhat similarly that we did. We're going to wait till the very end. We know that we had 6,000 units. We know that that ending inventory cost us 27,100 because we broke, because we know these costs as we purchase them. So the goods available for sale, again, will be 43,900. And we're going to deduct this ending inventory here of 6,000 units. Again, where did we get those units? We got them from the top. We got them from the top. And we kept the bottom in inventory. So to determine the cost of ending inventory, we take the cost of the most recent purchase and work back until it accounts for all the units in inventory in a periodic system. Now, when we do it in a perpetual system, again, we do it row by row. So here, our beginning balance was 8,000 on March 2nd. Then we bought another 6,000 units here. So we bring this row down, we bring this purchase across, and that's our balance at that point in time. Now, when we sell them, we go grab them from the top down. We're going to grab this 2,000 first here, and then we'll grab 2,000 from this 6,000 row here. And that's what we sold. And we kept 4,000 from this 6,000 that we did not sell. So our inventory at that point is 17,600. Now, when we purchase more, we're going to do the same thing. We're going to bring this row down. We're going to bring this purchase across, and we'll calculate then that we had 27,100 in inventory at month end. And that way, we will know exactly that the two of these become the 43,900 units that are available. So in all cases where FIFO is used, the inventory and cost of goods sold will be the same at the end of the month, whether a perpetual or a periodic system is used. Okay. Now in LIFO, now we're going to sell from the bottom and keep from the top. And so what we're going to do is it better matches the cost of goods sold against revenue because the last in that we're selling is the most current costs. So now if I look at that under a periodic system, I'm going to do the same kind of thing I've been doing for periodic. I'm going to have an ending inventory here of 25,600. And I know that because I'm selling, I'm keeping, I should say, from the top and selling from the bottom. So this is the top here, March 2nd and March 15th. And then the remainder goes to cost of goods sold. Okay. The cost of the total quantity sold or issued during the month comes from the most recent purchases. Okay, that looks like a good place for us to stop this video. And when we return, we'll take a look at perpetual inventory for LIFO. Until that time, bye for now.